You're watching Wall Street Confidential on TheStreet.com TV. I'm Farnoosh Torabi. Joining me here is Jim Cramer, co-founder of TheStreet.com. Hi, Jim. Now, Wall Street's investment banks kick off earnings this week, namely Goldman Sachs, Lehman Brothers, Bear Stearns, name a few. Let's start with Goldman Sachs. Let's talk about your take on them. You call them undervalued?
Yeah, they're undervalued because they sell a 10 multiple. Actually, I'll take the whole group because the whole group is hated. I mean, the whole group is perceived to be either levered to mortgages, as Lehman and Bear are, regardless of whether mortgage business is good or not, or linked to proprietary trading, the hedge fund desk, so to speak, of Goldman. None of these is valued on Wall Street because it's almost impossible to find any stocks that have a lower multiple other than maybe a Conoco, a Chevron. And that's because, on the one hand, the Conoco and Chevron have absolutely no growth. It's true, year over year. On the other hand, Goldman, Lehman, and Bear have huge growth. So I would argue both are undervalued, but it's Goldman, Lehman, and Bear that are substantially undervalued. There has been a belief that the quarterly reports have somehow influenced these stocks. I went back a year and a half. There is no correlation. This reminds me of something I'm going to talk about tonight on my TV show, which was the fiasco of Dick's. This is my 500 show tonight, so I'm like looking back at all my mistakes. Thank you. And I think that what you do with Goldman is you don't own it if you don't own it. Hope that it comes in after because it's been irrelevant when it's come in, and then buy the stock. The bigger issue for me is why do these banks get no respect? And I think that sometimes in life you have to just say they don't get any respect because the people who set the barriers are wrong, and the people who are creating the last price, the marginal price, so to speak, are wrong. Witness the fact that Goldman's up 50% year over year. I mean, if it were really doing badly, or if it were not meeting expectations, it would be down substantially. So I think you have to ignore the conventional wisdom. This is very rare. I typically don't think that you need, with a Medco Health, I would never work. Medco being the paradigm healthcare company, with a Apple or Google, I would not ignore conventional wisdom. But with these stocks, you do. And the reason why you have carte blanche to ignore conventional wisdom is something I found all my career, which is that if you buy under a 10 multiple, you're increasing your chances to make a lot more money than if you buy it over a 10 multiple.
Conventional wisdom may also tell you to buy on leadership for basing your decision, some of your decision, or your investment decision on leadership. Lloyd Blankfein, a report in the
But Dick Fold, Jimmy Kane. I mean, I love that Times piece, and I emailed Lloyd immediately. And we were joking about it this weekend that it showed you there's a humility that doesn't really exist at the other institutions. There's also a hunger that I often find doesn't exist at the other institutions. But they're all selling at bad multiples. So I hesitate to say that Dick Fold doesn't do a great job at Lehman and Jimmy Kane doesn't do a great job at Bear. These are just all unloved stocks, which is just a terrific opportunity for investors everywhere.
All right. Thanks, Jim Cramer. This is Wall Street Confidential on TheStreet.com TV. Don't go away.